Okay, so we're going to continue on today with chapter 3. Just have a couple of things left to go over, although those are the couple of things are a little complex. So we left off talking about specific types of income, and we're going through some of the most common types of income and the particulars about their taxability. We discussed interest income and how not all interest income is taxable. We have tax exempt interest. We discussed dividends and how qualified dividends have their own special tax rate, and that tax rate is dependent upon what the other taxable income is on the tax return. We discussed state income tax refunds, state and local income tax refunds. For our purposes in Iowa, we're really talking about state income tax refunds and how we calculate whether or not any of that refund is taxable, and if it is taxable, how much of it is taxable. And if you recall, it depends upon whether or not we itemized last year. If we didn't itemize last year, then none of our state income tax refund would be taxable because we didn't get any benefit from it. Remember, we're balancing out any benefit with any then current taxability. If we got a benefit last year and then we got a refund, then we got too much benefit last year. So it means we've got to pay for that this year. And so we looked at the calculations of determining how much of that state income tax refund would be taxable. And then we just briefly talked about unemployment compensation income, which is pretty clear cut. It gets entered in, you get a 1099-G form for it, and then it gets entered into the Schedule 1, which then flows through to the Form 1040. So now we're going to continue with Social Security benefits. So as most of you, I'm sure you all know, Social Security benefits, we're talking about income that is received by retirees. There are other types of income that Social Security will pay out, like Social Security disability payments. Those are not taxable. What we're talking about is the retirement benefits. Now, for a lot of people, a lot of retirees, individuals who are receiving Social Security benefits, they don't pay any tax on it. It all depends on how much other income is on that tax form. So in order to determine how much of our Social Security benefits are taxable, we have to do a couple of calculations. So one of the limits is how much other income is on the tax form, and then based on how much other income is on the tax form through a calculation that we're going to do called provisional income, and then we have to do a calculation, okay, if some of that, if we have enough other income on that tax return, then how much of our Social Security benefits are taxable? Never are more than 85% of Social Security benefits going to be taxable. Doesn't matter how much you make. You make, $10 million a year in retirement, good for you, by the way, and you receive Social Security benefits, and people who make that kind of money do receive Social Security benefits. There is no needs testing for Social Security benefits. Everybody who pays in and meets the minimum requirements is entitled to draw from Social Security once they reach their retirement age as determined by Social Security. So it doesn't matter what your income is, because you've paid into it, you get money out. Now chances are you're not going to get the amount that you put into it, but that's a whole other discussion about the insolubility of that particular program. But the most that will ever be taxable for individuals is 85% of their Social Security benefits. So if they received $10,000 in Social Security benefits, the most that will ever be taxable is $8,500. Okay. A lot of states don't tax Social Security benefits at all. Iowa is one of those. Iowa also does not tax retirement income. They used to have certain, like a $6,000, or $12,000 exemption for retirement income. Part of the new tax laws that were passed recently in Iowa that are flattening our tax. Also included in that was an exemption of taxation for retirement income. So we're trying to encourage individuals to stay here in Iowa when they do retire. But as far as Social Security benefits go in Iowa, they're not taxable. They haven't been taxable. I don't know if they've ever been taxable in Iowa. But for federal purposes, so that's the most that will ever be taxed. The least that will ever be taxed is that none of it would be taxed. Okay? So somewhere between most people, if they have other income on their tax return, depending on how much, most people, the taxable amount of their Social Security benefits is going to fall somewhere between 0% of those benefits and 85% of those benefits is going to be taxable. Now, when I'm using these percentages, it can sound a little confusing because we just talked about dividends that have a separate tax rate. I'm not talking about the tax rate on Social Security benefits. They don't have a special tax rate. It's just the amount of the benefits that are actually subject to taxation. So that's the calculation that we are going to start out with, and there are two parts to the calculation. The first part is actually relatively easy. It's the calculation of this provisional income. It's called provisional income. I don't know why. Provisional because it's, I don't know, what's provisional mean? Initial income, initial calculation. The calculation of provisional income, which I guess it's also called modified adjusted gross income. Modified adjusted gross income is a little confusing though because there are other calculations that use what's called modified adjusted gross income, but the calculations vary. Like what's included and what isn't included sometimes vary. And so using provisional income here makes it clear that we're just talking about Social Security. So what is our calculation of provisional income? It's the first thing that we have to do. Once we determine what our provisional income is, and this is just subtracting out, we start with a number and then we subtract out other add back or subtract out parts of that number to come up with a result. So it's just plus or minus items, nothing too complicated. Once we have that number, our second step is a little bit more complex. Then we have, based on what that provisional income number is, and based on what our filing status is, then we've got some more complex calculations that we have to do to determine how much of those Social Security benefits are taxable. So we're going to start with the easy one. We're going to start with calculating that provisional income. How do we determine that? So what we do is we take our adjusted gross income, so there's that word, adjusted gross income, before any benefits are included in the calculation. So we're not going to include Social Security benefits in there. So we take so if you're in the tax return and Social Security benefits have already been included in there before you get to that AGI number, which ordinarily they would be because they come above, they're entered above AGI, you'd have to pull it out. So if your AGI is $20,000, but included in that is $5,000 of Social Security benefits, you got to pull out that $5,000. Okay, so AGI before any Social Security benefits. Then we're going to add some items back in. Tax exempt interest. And it says most tax exempt interest. For our purposes, it's all the tax exempt interest. So the tax exempt interest is listed on the tax form on that 1040, but it's not been included. That amount has not been included in AGI. It's not been totaled in that AGI number. So now we have to add it back. Okay? Doesn't mean it's going to be taxable, but for purposes of determining what that provisional income number is, we got to add it back. Okay? Then any employer provided adoption benefits, which we'll go through some of those items. Your problems aren't going to include that, but some employers will provide reimbursement of if an employee adopts a child, they'll help to provide reimbursement for any of their expenses. If that happened, that amount wasn't included in AGI, so you got to include it now. We're going to add it in there. Excluded foreign income. So there is this thing called a foreign income exclusion. Remember I said that income is taxable regardless of where it comes from. It is included on the 1040, but there's a certain amount of exclusion if the taxpayer meets certain requirements. So if you are living outside of the US for more than like 330 days of the year, so you're living outside, working outside of the US, if it's under a certain amount, so up to a certain amount of that foreign earned income can be excluded from taxation. So it wouldn't have been included in AGI. It's like, I can't remember the exact number, it's somewhere around $100,000. So you can earn up to that much and not have it be taxed by the US. But if you have that, it was never included in AGI, so now for provisional income, we've got to add it back. Deducted interest on educational loans. This is student loan interest. So if you had, and student loan interest would have been deducted from AGI in our calculation. It's one of those adjustments, and we're going to talk about that in the next chapter. We have to add that amount back. That's never going to be more than $2,500, which you'll know why in the next chapter. Maybe some of you already have experience with it. This one doesn't really apply anymore because it doesn't exist. Deducted tuition and fees. There used to be a deduction for tuition and fees. There's no longer a deduction for it. There's credits, but there isn't a deduction. So, I mean, it's there. If you had taken it, you would have to add it back. Then you add back 50% of the Social Security benefit. So in my example, we had $20,000 of AGI, but it included $5,000 of Social Security benefits. So our first calculation would be to take out those Social Security benefits. So we started AGI of $20,000, but we had Social Security benefits of $5,000 that were included in that. Now we're going to take those out. So now it's at $15,000. But we have to, assuming we don't have any of these other things here, we have to add back 50% of those Social Security benefits. So $2,500. In this example, that would be our provisional income. If we did not have any of these other items. Okay, we just had AGI and Social Security benefits. Let's get a little bit more complicated though. Let's say that we started out with AGI of $20,000 and we have Social Security benefits of, we'll go back to $5,000, that's fine. Of $5,000, and then we have tax exempt interest of $3,000. All right. Social Security benefits we're going to take out. But that tax exempt interest, because it was never part of AGI, we're going to add that back in. And then we're going to add back half of these 50% of the Social Security benefits. Oops, that's not an S, so I don't know what that is. Plus $2,500. Okay, so what was that? 15,000, 18,000, 20,500. This is our provisional income. Here, 20,500. Okay. It's not real complicated. Like I said, you just have to remember, because that tax exempt interest, it can be hard, it can be easy to forget about it because it's not showing up. I mean, it's listed on the 1040, but because it's not taxable, it's easy to forget about. But that has to be added back, and then also not forgetting to add back that 50% of the Social Security benefits. I'm not sure any of your problems really include any of these other items. Maybe the student loan interest. I wish they just called student loan interest because that's what we all call it. But if you had deducted any interest, that was deducted from the AGI, then you gotta add it back. Okay? That's our provisional income. Any questions on that? That first part? All right. Before we go to the second part, I'll just introduce you to the SSA 1099. Maybe some of you have seen one of these, maybe not. This is what, so when you're an employee, you get a W-2 at the end of the year showing what your income was and what your withholding was from your job. If you have interest income, you get a 1099 INT. If you have dividend income, you get a 1099 DIV. If you have Social Security income, you get one of these. If it's disability income, you don't get one of these. But for Social Security recipients, this is what they get. So it's got their name, it's got their net benefits. Box 5, this is what the amount that would then go on the tax form. For total Social Security benefits. This doesn't necessarily mean that they're not all going to be taxable. Remember, the maximum amount that can be taxable is 85% of them. But over here, usually what they have is details about like Medicare that was withheld and stuff like that, like your part, I don't know if Part B comes out of your benefits, but like Part D, I can't remember how many parts they have these days. But anyway, that's usually what's there, is information about Medicare payments that were made. If you're doing taxes, you do extract this information. You use this on the tax return because it can be beneficial to taxpayers if they qualify for certain deductions and stuff. So it can be included in there. Then if they chose to have any federal income taxes withheld, it would be listed there. There's also, I think there's another part to this that shows any state income taxes. Well, I don't know if they withhold any state income taxes. I'll take that back. But individuals can have federal income tax withheld. They can choose to do that. The default is not to, which is also why a lot of times I said, retirees and self-employed individuals are the ones that usually have to make those estimated payments. But another way to do that is if you get Social Security benefits, you can have it withheld through Social Security benefits. So that's what the form looks like. It's big. It's like a regular size. It's like really long. It's one of those that you have to tear apart. It's about that long. It's red, pink, red, sort of like that. And that's what that looks like. All right. Now, so we've got our provisional income. This is when it gets really fun. So based on what our provisional income is that we calculated already, and based on what our filing status is, we use this chart to determine how much of those Social Security benefits are taxable. So, married filing jointly, single, head of household, or qualifying widow or widower is over here. I think, is married filing separately over here too? I'm not quite sure. I think it must be over here as well. So either married filing jointly or other, pretty much. So you take that provisional income, so in our case, $20,500. Let's just say that our filing status, well, it's not really enough to do anything with, but we'll say it's married filing jointly. So we do the calculations, and our provisional income is $20,500. Using this chart, if our provisional income is less than this amount, less than $32,000 for married filing jointly, none of it is taxable. If we were any other filing status, $20,500, if it's less than $25,000, it's also, none of it is taxable. So 0% would be taxable. You're still gonna list the entire amount of Social Security benefits on page 1 of the Form 1040. There are 2 columns, the tax and 2 boxes for Social Security benefits. Total benefits and taxable portion. Only that taxable portion is gonna be added into to include it in our total taxable income. So that's what we're trying to determine, what that amount is. So if it's below that amount, then none of it's taxable. So in our example here, none of it's taxable. If it is above these amounts, $44,000 for married filing jointly, or $34,000 for single, then 85% of it is taxable. So in our case, we had $5,000 of Social Security benefits, whatever, half of $8,500, so $4,250 would be taxable. So we'd have, no, 5,000 times 85%. It's 5,000 times 85%. Anyway, whatever that is, that amount is going to be what's listed then under the taxable portion. Total portion could be 5,000. Taxable portion is going to be 85% of that. However, if our number falls between those thresholds, then we've got some fun calculations to do. All right, and there are, like I had mentioned before, there are a lot of if, or, lesser than, greater than. It's a little, it can be a little complex. You have to read very carefully. Okay? Amber, you look frightened. Oh, actually, I kind of said that wrong. It's the 85%. So above that, there's another calculation. If it's below that, I forgot that was, that there's a, but we'll go through that calculation. So if it's below this, none of it's taxable. If it's above this, 85% might be taxable, but we got a calculation to do. If it's between, we've got a calculation to do. And the between is actually the easiest one. So let's make something up here. Let's make this bigger. AGI of 50,000 instead of 20. So this is now 50,500. No, I want it to be between. So let's start out with 30. Makes that 30,500. Can I erase this? I need some space. All right. So our provisional income is 30,500, and we are single. All right, so 30,500 falls between 25,000 and 34,000. So the taxable portion of the benefits, if provisional income is between the two limits, the amount that's taxable is the lesser of 50% of benefits or 50% of the excess of provisional income over 25,000. So we have two calculations to do. We're going to choose whichever is least. So option A is 50% of benefits. Benefits are 5,000 times 0.5, 2,500. Okay, so that's option A. Option B is the excess of provisional income over 25,000. Well, we're going to take provisional income minus 25,000 It's really loud. So 5,500. The lesser of those two. Okay? That's how much is taxable. 50%. Let's change things up a little bit. Let's make our Social Security benefits higher. let's make our AGI higher and our Social Security benefits higher. So, say it's 25,000 and our AGI is, that's too high. 70,000. Which means that half of our Social Security benefits now are 12,500 that we have to add back, right? All right, so our provisional income will still be, well, we'll see how we end up, and then I'll determine whether we're still single or not. All right, so 70,000 minus 25,000, so what's that? 45,000. Did I get that right? 45. Yeah, 45,000. 48,000 plus 12,500, 48, 50, 60,500. That's too much, but that's all right. We'll go to the next part. So, if we are single and our provisional income is 60,500, now it is not between these amounts, it is above the upper limit. The upper limit is 34,000. So let's go to the second one. Now, it is the lesser of 85% of benefits. So this is between, and this is over those numbers. So the lesser of 85% of benefits, so 25,000 times 85%, what is that? Somebody wants to do a calculation for me?
21,250.
21,200?
250.
250. Okay. All right. Or B, 85% of the excess of provisional income over 34,000 plus the lesser of 4,500 or 50% of benefits. Okay, so we got a couple of other calculations to do here. 85% of the excess of provisional income over 34,000. All right, so first part of this, we're going to just subtract the 6,500 minus 34,000. Right, so 500. 26,500. Now we've got to take 85% of that, right, times 85%. How much is that?
22,525.
22,525 plus either 4,500 or 50% of benefits, whichever is less. So, in our case, 50% of benefits is 12,500. It's always going to be this number here, whatever this was. 12,500 or 4,500, whichever is less of those. 4,500 is less, right? Plus 45. Did I get that right? 100. Yeah, I did. Because this is option A and this is option B. So 0, 2, 5, 5, 6, 7, 27,025. It's the lesser of these two. This one doesn't make sense anyway because it's more than actually Social Security benefits were. So in this case, it's going to be 85%. There's a lot of steps to it. But if you follow it and read very carefully and kind of put together your little if-then or flow chart when you're doing it, it makes it easier. All right, let's do another one here. Let's say we've got, so we'll do both calculations here. Well, you guys give me the number. So Give me an AGI. 55,000. What's our filing status?
Qualifying widow.
Qualifying widow. Okay, so you're just making it more difficult for me here, aren't you? So yeah, we're gonna use this. It's like they're as though they're single. Qualifying widow. AGI of 55,000. How much Social Security benefits do we get? 12,000. Okay, and they're we'll assume they're included in there. Any tax-free interest? $400. Okay. 400 non-taxable interest. Let's say that we also had some student loan interest of, I don't know, 2,000. That was subtracted there. Okay. And then we've got our 1/2 of our Social Security benefits, right? All right, so here's our numbers. We have to figure out, do we add it or do we subtract it to get our provisional income? We can go back and take a look at our chart. That's helpful. All right. So, we also have to add, I forgot this one because it's a tax exempt. Interest on U.S. savings bonds that were excluded for educational purposes. So if you got some income from, you redeem some bonds and then use them, use the income to pay for education, it would have been excluded from your taxable income. Now you've got to add it back by here. Okay. So, Social Security benefits, are we going to add that in or subtract it? It is included up here. All of these things, well, except for 1/2 of this, all of these things are included up here. We're going to subtract it, right? We're going to take that out. Non-taxable interest, we're going to add that back. Student loan interest, and we're going to add that back. And 1/2 of the Social Security benefits, we're going to add that back, right? Okay, so somebody do the math. 51,400. All right, so here is our provisional income. 51,400. We're going to apply it to our chart based on our filing status. We are a qualifying widow or widower. So we are not below 25,000, obviously, and we are not between. We are over. So we got to do this fun little calculation. We've got 2 options now. We've got option A and option B. Option A is super easy. It's 85% of benefits. So 12,000 times 85%, which is how much?
10,200.
All right, so that's option A. Option B, more complicated. 85% of the excess of provisional income over 34,000. So 51,400 minus 34,000. I get that right?
Mm-hmm.
Okay, 17,400, but 85% of it, right? So now I need a calculator.
14,790.
790, okay, so we got here, 85% of the excess of provisional income over 34,000 plus, whichever is less of these two, 4,500 or 50% of benefits? 4,500. All right. 2,9. So 19,290, well, obviously it's not gonna be that again either because that's more than our Social Security benefits were in the first place. But we're gonna do the lesser of these two. So 10,200 is what's taxable. Okay? Which is 85%. Can you see it? I know, I'm sorry, I'm short. Well, and this is low.
So this number at the very end is what we're looking for to put into line 6 of 1040.
Yes, the taxable portion. The total benefits, the 12,000, are gonna be just over to the left of that number. Total, and then the taxable, so this is gonna be, this is what's gonna be in the taxable one. Let's go over here and do one that would fit into that category. And, okay, I think we've got the calculation of provisional income down, so. Let's see here. All right, so let's have somebody that's married filing, well, let's do this one first. Married filing jointly, and it's $40,000 for the provisional income. So, that's between 32 and 44, lesser of 50% of benefits or 50% of the excess of provisional income over 32,000. All right, so we do 32,000, 8,000 times 50%, 4,000. So that's actually B, calculating B first. A, 50% of benefits. Well, I didn't do the benefits. Let's say it's 10,000. 5,000. In this case, it's gonna be B. So 4,000 of those benefits is gonna be taxable. So 40% in that case. So let's say that this is, we'll still do benefits of 10,000, married filing jointly. We'll do over that, we'll say 50,000. Okay. So provisional income is 50,000, lesser of 85% of the benefits. So option A is 10,000 times 85%, 8,500. Or 85% of the excess of provisional income over 44,000. All right, so minus 40, 6,000. This is B. 6,000 times 85%. All right. How much is that?
What is 85%? 5,100.
85% of that. How much is it?
5,100.
5,100, okay. Okay. Plus, whichever is less, 6,000 or 50% of benefits. 5,000 is less than that. 10,100. So we're gonna take whichever is less of these two. 8,500. Okay. So you can see there 85% of the benefits were taxable in that scenario. Fun? All right. Questions? You guys are just soaking it up. That's awesome. All right. Let's see. I'm not going to go through these examples. They've already done. There is a worksheet here that if you wanted to read, I think it's easier to read their table, but if you wanted to use the worksheet, you could go through and answer all the questions. It just takes you through the same calculations as what we just did.